Canada's big housing market collapse of 2024. Margin call coming to Canada housing market. In a recent video by Cheung, he provides a crucial discussion that could have far-reaching consequences for not just Canada but the entire global financial landscape. His video is a critical look from an outside observer with seemingly no stake in the Canadian real estate market. The analysis dives into the heart of a growing storm, one that's been brewing in Canada, where the real estate market is showing signs of unprecedented vulnerability. In our video, we'll explore and highlight the critical factors that are discussed in Cheung's video. These issues described make Canada's real estate situation a ticking time bomb, ready to send shockwaves around the world. From the prevalence of variable rate mortgages to soaring property costs, a confluence of limited supply and immigration-driven demand, and a high level of investor ownership, there's a perfect storm on the horizon. And that's not all. We'll break down the ominous concept of negative amortization, how it's affecting homeowners, and share a real-world example that will leave you astounded. But the real question is, could this Canadian crisis be the epicenter of a global financial earthquake? Join us as we unravel the intricate web of factors that make Canada's real estate market a potential catalyst for a worldwide financial meltdown. Before we start, please click the like button and subscribe. We'll be discussing these and similar issues in the future on this channel, and we welcome your comments and input. The original video by Cheung on YouTube, published on October 17, 2023, provides an in-depth analysis of the concerning state of Canada's real estate market and its potential to trigger a financial crisis with global repercussions. Let's delve into each of the key points and examples. Variable rate mortgages. One of the primary reasons for concern in Canada's real estate market is the prevalence of variable rate mortgages. Unlike the United States, where many homeowners opt for fixed-rate mortgages that offer stability in the face of rising interest rates, a significant portion of Canadian homeowners have variable-rate mortgages. This means that their mortgage payments are directly impacted by fluctuations in interest rates. As a result, Canadian homeowners are more exposed to the decisions made by the Bank of Canada regarding interest rates. High mortgage payments. The article highlights that mortgage payments in Canada can consume close to 60% of household earnings. This high financial burden places Canadian homeowners in a vulnerable position, particularly in cities like Toronto and Vancouver, where property prices have reached staggering levels, often exceeding $1 million. This has led to a situation where a significant portion of the younger generation, including Gen Z and millennials, is effectively priced out of the housing market. The burden of mortgage payments, coupled with increasing interest rates, adds stress to an already precarious situation. Limited supply and population growth. The real estate crisis in Canada is further exacerbated by a combination of limited housing supply and substantial population growth driven by immigration. The country's immigration policies have been successful in attracting a diverse pool of immigrants, leading to population growth, which has further increased the demand for housing. The resulting supply-demand imbalance has driven up property prices. Policymakers are grappling with these challenges and are even considering measures like capping foreign student numbers to curtail population growth. This highlights the depth of the problem, where even education policy intersects with real estate issues. High ownership by investors. Canadian investors have a significant stake in the real estate market. The article points out that investors own between 20% to 30% of single-family homes in various provinces. Moreover, many of these investments are made with high leverage, meaning investors have borrowed significant amounts to invest in real estate. This high level of investor ownership, coupled with leverage, makes the market highly sensitive to market shocks. When interest rates rise, investors with leveraged positions face increased financial stress, which can have a cascading effect on the overall market. Negative amortization. Negative amortization is a critical issue. This occurs when borrowers' monthly mortgage payments are insufficient to cover the interest on their loans. As a result, the unpaid interest is added to the principal, causing the mortgage balance to grow instead of shrink. In other words, Homeowners are effectively fighting compound interest, and this can extend the time required to pay off the loan dramatically. Example of negative amortization. To illustrate the concept, the article mentions a specific case. Michael from Canada. He took out a variable rate mortgage just last year, anticipating manageable payments. However, the Bank of Canada raised interest rates rapidly, which led to a sharp increase in his monthly mortgage payments. As a result, his 25-year mortgage extended to a staggering 47 years before he could pay off the full principal and interest balances. This example demonstrates how quickly and dramatically homeowners' financial situations can change due to unexpected interest rate hikes. It's essential to recognize that Michael's situation is not an isolated one but a concern for a significant portion of Canadian homeowners. Bank of Canada's rate hikes. The Bank of Canada's aggressive rate hikes have exacerbated the issue of negative amortization. While central banks typically use interest rates as a tool to manage inflation and economic stability, the rapid pace of rate hikes in Canada has added immense pressure on homeowners. The Bank of Canada's decisions directly impact those with variable rate mortgages and can also affect those with fixed rate mortgages when they come up for renewal. This means that every month without relief from the central bank leads to a larger problem compounding in the background. Global impact. The most concerning aspect highlighted in the article is the potential for a global real estate margin call originating in Canada. This is a reference to a situation where investors are required to deposit additional funds to cover losses. In the context of real estate, it implies a widespread financial crisis triggered by the Canadian real estate market. It is suggested that while global financial crises in the past have often been associated with the United States or China, the unique combination of factors in Canada, including the prevalence of variable rate mortgages, high homeowner indebtedness, and aggressive interest rate hikes, make the Canadian real estate market a potential trigger for a significant financial event. Our video has presented a detailed examination of the vulnerabilities in Canada's real estate market, including variable rate mortgages, high housing costs, limited supply, significant investor ownership, and the problem of negative amortization. The example of Michael's mortgage illustrates how rapid interest rate hikes can dramatically affect homeowners. These factors, combined with the Bank of Canada's aggressive interest rate policies, create a precarious situation that could have severe consequences for Canadian homeowners and potentially resonate throughout the global financial system. What do you think about the vulnerabilities in Canada's real estate market? Will they lead to a drastic market collapse in Canada that could have consequences throughout the entire global financial system? Or will Canada and the rest of the world avoid any substantial real estate market downturn? Please join in on the conversation by leaving a comment. If you found this video and information useful, please smash the subscribe button and hit the notification bell so we can keep providing you with timely information you can apply on a daily basis.